First and foremost, welcome everyone. Thank you for taking out time for joining this webinar. The topic for today's webinar is, we are covering PTCs, which is pass-through certificates. So how can PTCs, enhance your fixed income portfolio? So PTC and, securitization is an emerging asset class in India. It is a very popular asset class globally. And as this asset class gains more, I would say, mainstream popularity in India, we thought it'll be good to have a webinar on how this is actually relevant in every individual investor's portfolio. So having said that, let me introduce our today's speaker and guest. His name is Mr. Arvind Rangaranjan. So I'm very happy to have him on our webinar with us. We've been collaborating now for the past couple of years, and I can tell you he's one of the foremost experts in this space. He will also introduce himself later, but a few words about him. So Arvind sir has basically, been, I would say, at the forefront of this industry, both in structured trade finance as well in securitization, as an asset class itself. He's formerly worked with Deutsche Bank, Standard Chartered, Barclays, World Bank, and he's also, if you see, he's been a pioneer in this space. So having done India's first cross-border securitization for Jet Airways back in 2001, when I would say this market was very nascent, even in the institutional space in India. He's, starting from there to obviously helping establish India's first electronic trade platform in 2004. So he's been at the forefront of, growing this industry over the past 2.5 decades. And also, beyond securitization itself, he's, been doing structured credit. So he's done credit trading, structured trade finance. He was the head of structuring for Deutsche Bank's, investment banking and structured trade finance in India. So he's been, I would say, he's, seen and done it all. So a very experienced and senior person. And, we always look forward to his guidance here at Jiraaf when we are working on PTCs and securitization. So we are very happy to have him today. So, welcome Arvind sir. So I will just introduce Jiraaf for maybe first time listeners that we have, and then bring in Arvind sir to do most of the talking. So my name is Saurav Ghosh. I am one of the co-founders of Jiraaf. For people who are still new to our platform, we are basically an online bond platform. What we do is essentially help individual investors like yourself participate in fixed income products. So most of us as individual investors today have largely participated in equities, maybe direct through mutual funds, real estate, gold. But fixed income as a category, is still very new and nascent. Fixed deposits is the most traditional form of fixed income that we do. But beyond fixed deposits, now bonds and PTCs and securitization is really, gathering pace in India. So, as Jiraaf, that's our singular mission, helping individual investors like you, invest in fixed income beyond fixed deposits. So that is bonds and PTCs. And we are a digital platform that is helping you do this with a click of a button. We are obviously a SEBI licensed bond platform. So, that online bond platform is a license category provided by SEBI. So we are a stockbroker in the debt segment. We also are like as a fintech from the startup ecosystem. We are funded by marquee investors like Accel and Harmony Ventures. And the entire leadership team at, I would say, Jiraaf, today we are about 100, people. All of us come with significant experience in, the banking and financial services space. And, we are trying to see how can we make this product category easy and simplified for individual investors like yourself to participate. Today on Jiraaf, you get multiple products. So you'll get access to corporate bonds between, I would say, triple B to all the way up to triple A rated corporate bonds. We also distribute, sovereign securities, which is your GSEC and T-bills. And recently we launched a product in partnership with Artfine on the PTC and the securitization. So we've recently launched our PTC as well. So today, basically corporate bonds, listed corporate bonds on BSE and NSE, T-bills and GSEC, which are sovereign securities, and now PTCs, which is the third category in the fixed income space. So the idea is to help an bring to you products that were not easily accessible. Now you can access all of these through a click of a button through our platform, Giraffe. So here I bring in Arvind sir. So this is, he is the founder of the NBFC and the company called Arth Padarth Factors and Finance. Is again one of the player that is, been at the forefront of deepening the securitization market in India. And I will now invite Arvind sir to give maybe a short introduction again of himself and, then of what exactly Art Finance, is doing in the market today.
Thanks, Saurav. Very kind introduction. I have been a banker for nearly 30 years. And now my current avatar is as the founder running ArtFine. So ArtFine is our attempt to take trade finance to the capital markets. So traditionally, the capital markets are a place which appreciates cash flows, which appreciates good track records. And we want to use that criteria and characteristic to be able to fund sectors which do not easily get financing. So in India, the biggest area which is lacking in finance is small and medium enterprises. And we felt that we can add value in a very interesting new way, which is to look at the trade receivables of small and medium enterprises, which are due from top companies like Amazon, Flipkart, HDFC Bank, Tata Motors, and so on. So this is what ArtFine is all about. We lend as a factor. We are an NBFC regulated by the Reserve Bank of India. We have a factoring license. So this is a special license where the parliament, which amended the Factoring Act in 2021, said that an NBFC who is registered as a factor can sue the buyer if he doesn't pay. So normal NBFCs, when they lend and do invoice discounting, they cannot go to the buyer and say, hey, you have to pay me. But an NBFC factor like us has the right to serve a notice of assignment on the buyer like Amazon or Tata Motors. And if they don't pay, then we can take them to court. You would have all seen recently that 2 or 3 large, well-rated listed companies were sued in NCLT and the payments got paid within 15, 20 days. So that power to sue, take people to NCLT is an important remedial measure which is now accessible and available to people. And having this license gives us that right. So Arthpadat Factors in Finance is one of only 12 NBFC factors in the country. We are the only one who does securitization. And that's because our target audience is small and medium enterprises. We have a fully digitized process. We were a champion of financial inclusion largely because we focus on small and medium enterprises. We were the first factor to use insurance on trades. And we have, so far, we've done over 250 crores of disbursements in the current year. We've got over 7,000 dealers in our collection network. That is, we just collect the money. And we have got over 100 MSMEs who are currently our clients, supplying to more than 200 top buyers who are all rated AA or AAA. So that's briefly about AP Factors. Thanks, Saurav, for inviting me. Saurav's been a great partner, and Giraffe's been a wonderful organization to work with. So thank you for the collaboration as well. Thank you.
So, Avinta, I think you spoke, just to make it easier for our listeners to understand. I think the most simple question which I want to address on this slide is how would you define a factor? So, what is a factor? And when you say that you are financing MSME and SMEs in India, which is your, championing the financial inclusion cause, typically we understand the MSME, SME to be a risky segment. Let me put it this way. So, as a credit provider or as a lender in this ecosystem, how are you able to draw comfort on this space? So, so what is a factor, and then how do you draw comfort on MSMEs and SMEs?
Yeah, thanks, Saurav. Excellent question. So typically, all economic activity is in the form of trade. So people do a service or supply goods, and for that they raise an invoice. They raise an invoice, and there is a seller who's done the services or who's manufactured the goods or who's supplied the goods, and then the buyer is the person who actually has to pay now that he has got the goods or he has got the services. So the invoice says how much do you have to pay. Now, when you're a factor is somebody who steps in at this stage, and typically payments between the supplier and the buyer take 30 to 90 days. The factor comes in and says, you don't have to wait 90 days. I will finance the seller immediately and I will wait for the buyer to pay me. So the factor's role is that of providing working capital finance to the seller after the transaction is complete. It's always the case that the transaction is complete. Now, how do we ensure that the buyer does not say, hey, the goods were defective? Oh, I didn't get the goods. We go and check on the portals. We check the Amazon vendor portal, the L&T vendor portal. We see, is this invoice accepted? Have they said this amount is okay? Is the payment terms 30 days or 60 days? What is the tenor? So we have our bots which go every day, check out what is the invoices which are approved. Only then we finance. The second step that we do is all payments from the buyer come into an escrow account. That escrow account, before we did the securitization, was controlled by us. But now that we have done the securitization, Access trustee controls that escrow account. So even we cannot touch those cash flows. They come from L&T or from Amazon or from Flipkart, and they straight away go to the trustee. The trustee then says, okay, tell me what is this about? So we will then say, okay, these are the invoices which we financed. Some of them relate to securitized amounts. Please take those monies. So the security trustee takes away those monies, and the balance amounts which are not related to the securitized invoices come back to us. So then the trust has basically got its money back. We then supply new invoices, and this is pretty much the process. It happens every day virtually. So typically, while our PTC may be for 14 months, we churn it about 7 times. So if you have funded 10 crores of PTC, in a year, it'll go up to 70 crores of financing for small and medium enterprises. Although the beneficiary is a small and medium enterprise, the payment risk is on the buyer. The buyer has accepted that he will pay. That's usually a AA or a AAA rated entity. And in fact, in the current portfolio, there's only one A minus rated entity. The rest of them are all AA or AAA rated. Although we have the leeway to put 3 such names. And we take a mix of this pool, and the factor has the right, by virtue of the law, to go to Amazon and say, hey, you confirmed that this was due. You should pay me directly. So we are not dependent on the MSME. He's the guy who did the service, but now the entire risk is predicated on the buyer. Now, it's not only we who say so, the rating agency says so, based on legal opinions from Cyril Amarchand Mangaldas. So they have also verified it. They've said, okay, you got it on the portal. You have the right to sue them. You can take them to court if they don't pay. So that process is what enabled ICRA to take the call that actually this is a pretty safe asset. So hopefully that gives you some perspective on this.
No, thank you so much. Just to, I think summarize what Arvind has said in 2 lines again. So one factor is someone who comes in between today a supplier and a buyer of goods and to provide credit, through to ease out the working capital problems of MSME SMEs. So the suppliers over here are typically the MSME SMEs. Earth Finance, for example, comes in as a factor who gives the capital to MSME SMEs on day zero. So their working capital problem gets solved. So the beneficiary of the money that Art Finance or Earth Padarth is giving is the MSME SMEs today. So their working capital is immediately unlocked. With sitting on risk that the buyer, these buyers are large companies like Amazons and L&Ts of the world. So the buyer will then pay after 90 days to a escrow controlled account of Art Finance. So Access Trustee manages the escrow of Art Finance, where the money from the big buyers, that is Amazon and L&T, comes in. So while we are helping and solving the problem of MSME SMEs, the risk is actually sitting on these large companies, which are Amazon and L&Ts of the world. And that is how we are able to draw comfort and do this working capital financing. So, I think that's just to summarize, in a nutshell. Now, this is what is supply chain finance. And, this is most of us understand is invoice gets raised and, then the buyer pays after a credit period and a financer comes in between. Now, what effectively is securitization? So again, I will let Arvind sir, explain this. And, once he's explained, I can ask him some more questions, that we typically have as individuals. So Arvind sir, again, over to you. If you can explain in simple terms. Now we understand that obviously an invoice is getting raised, a buyer is going to pay after a certain credit period, and that is one single transaction, of, let's say, factoring. How does PTC come into this picture, and what exactly do we do when we say we are securitization?
Yeah. Thanks, Saurabh.
Hmm.
In a securitization, so typically we have a large number of invoices which are due from top names. Now, can we sell these invoices? We can. We can sell them one by one to individual investors. But what we do is we take a pool of them. We say, okay, this pool should be, composed of a certain set of criteria. So there should be maybe a minimum of 10 buyers so that you're not exposed to only one buyer. So the receivables from Amazon comprise maybe 10%. Receivables from Tata Motors comprise 10%. Receivables from L&T comprise 10%. Like that, we make a pool and we assign this pool to a trustee. In this case, the trustee is again Axis trustee. So the trustee holds the pool and he has to get money from these invoices. So typically, the pool will get paid at the end of 60 days or 90 days. And because invoices have varying tenor, there are cash flows which come every day. So the probability that there is a small chance, however theoretical, so far we've had no risks, we've had no defaults. Even our invoices have rarely gone past 5 days of overdue due to technical reasons. But having said that, even for the best names, there is a small probability of default. So what the basic premise is that if the cash flows are diversified, if you're getting money from several sources, not all will fail at the same time. So what the rating agencies do is they say, okay, look, you got to get 100 rupees from 100 different people. The right to receive the first 80 rupees is called the senior tranche. So we separate and segregate the cash flows into who gets paid first, and then who gets paid second, and who gets paid last. So this is the senior tranche, the subordinate tranche, and the equity tranche. So we get paid last as the originator. So the last 15% of the pool is funded by us, and we will get paid last. The subordinate guys will get paid second last. So the senior guys get paid first. So even if three guys fail, the senior guys will get all their money back without any problems. If two guys fail, the subordinate guys and the senior guys will get their money back. Only we will be suffering a loss. So because of the priority of payments, the senior guys are rated A minus. The senior tranche is rated A minus. The subordinate tranche is rated lower than that. And then the equity tranche is not rated. All of this is spelled out by the Reserve Bank. And we follow those regulations. We are required to give a return to the Reserve Bank every quarter, which we do. So hopefully that gives you some sense, Saurabh.
Again, to before asking question, to summarize what basically Arvind sir said is, typically there are multiple invoices. That mean many vendors or suppliers or these MSMEs, multiple MSMEs have raised multiple invoices to some of these large companies. So Amazon, Tata Motors, L&T, as some of the names he mentioned. So what we do is in securitization, pool all of these invoices. And when we say invoice, it means you pool receivables under these invoices. So that means cash flow coming from a Tata Motors, L&T, all of that. So you pool them together and we create a single instrument. This single instrument is PTC, which is a pass-through certificate. This is what individual investors like yourself are investing. So you own an instrument called PTC. This is in dematerialized form. So this PTC will reflect in your demat account and so on and so forth. So when you own a PTC, you basically own this instrument, and that means you're legally eligible to get a proportionate share of these cash flows from these big companies. And when these big companies pay, and through the escrow mechanism, you will get your money back. Now, the second thing what Arvind sir was mentioning is basically how to understand risk. So, for example, if there is 100 rupees of cash flow that comes in, as Arvind sir said, the equity tranche is the last 15 rupees which Art Fine has. So basically, even if 10% or 15% of this pool defaults, the individual investors who are part of the senior tranche and the junior tranche actually don't get any impact, right? So that's the way to think about it. And you're anyway dealing with such very high quality names with diversified exposure across multiple such names. And in that also, there is a buffer that up to 15% default, no individual investor will see any loss. So that is the way. This is again as under the RBI guidelines. In case of listed instruments, we also follow the SEBI guidelines, which is the current opportunity that you see on Giraffe. Right. So this is to summarize. Few questions, for Arvind sir over here. So typically, how should we think about risk in any PTC? So, like today, if we have to look at this transaction, which is on Giraffe, how should we think about risk? And second is if you have to compare this PTC with some other PTC, how can we compare risks of two PTCs? What should we typically look at? Like, what are those data points that will help us, get an understanding of the risk?
Yeah, thanks. I think the seniority or the ability to get money first is an important criteria. So a senior PTC is a little safer than something which is subordinate. But let me be clear. I think in all securitizations in India, the default rates historically have been low. And that is because you only do a securitization after there is a track record. So unlike a bond, which I mean, somebody who's new can also issue a bond, and it depends on that particular company. In a securitization, you need a track record. The second thing that goes into the securitization is the asset class. So there are two types of asset classes. Assets which are completely unsecured. That means that look, if you have bought a truck and your truck loan is 2 years old, you've already paid a lot of money towards retiring the loan. So your equity in it, your stake in it has gone up. You're a lot less likely to default. In a personal loan, there is no such uh, you know feature. If you've repaid 20% of your personal loan, you're exactly at the same position as if you had repaid 50% of your personal loan. By repaying the loan, you get nothing. It's an unsecured loan. That's where it is. The trade finance is a different class of asset. What happens if you default on a trade finance obligation? You've discounted an invoice, it doesn't get paid. The buyer gets upset because he can be sued in NCLT, his banking lines get frozen. The seller gets upset because his working capital is entirely disrupted. The banks will stop funding him. If one NBFC reports him to CIBIL, the entire banking system takes note because it immediately gets reported in the next month. And then they say, hey, you're in SMA 30, you're 30 days overdue. What is happening? So it is a significant deterrent that this class of asset, unlike in a personal loan, will cause the banking system to freeze if you delay or default. And that is the reason why this particular asset class has performed so well for banks. The historical default rates for vendor finance, dealer finance, etc., working capital, short-term bills is extremely low. It's less than 0.5% across ratings. And that is over several decades. And that is the experience we wish to bring to the capital market because hitherto this was not available to the capital market. It's such a short-term asset that it is very difficult to do a PTC unless you replenish. RBI allowed this 2 years ago to say, okay, you can do a replenishment, you can do a 12-month instrument. If the invoice gets repaid in 30 days, you can put new invoices. They gave the special permission. That's why this asset has now come to the market. Like any new asset, it's new. People don't yet know it very well, which is why you're seeing the first deal with Giraffe, and there is a certain element of novelty to it, and people who are willing to experiment are able to take advantage of the higher rates than you would normally get. So vendor finance typically gets funded by banks at 8%. Here we are offering you a much higher return, and that is the difference. For a similar class of asset on trades, you would get rates as low as 6.5%. Tata Motors invoices are discounted on trades at 6.5%. Yeah, you would get effectively a much higher rate.
So to add on to Arvind sir's point, he made a very valid comparison that when you do a PTC of trade finance receivables versus when you do a PTC, let's say, of another NBFC, which is basically has an underlying book of unsecured loan or auto loan. I think the one key difference that people need to understand is when you do unsecured loan or auto loan, you're relying on the underwriting capability of that NBFC. So the underlying quality of the book, the underlying capability of the NBFC, and in those cases, the underlying, like in unsecured personal loan, it is effectively small individual, like, individual investors who have borrowed money. Again, in case of auto loans, commercial or two-wheeler, in those kind of things, again, these are individual borrowers. When you are doing trade finance, you have moved away from a individual borrower ecosystem, which is basically what unsecured loans are and auto loans, for example, are, or even gold loans are. These are typically, or even when you see LAP, all of these are borrowers on this side are individual. That means that when you have done a PTC, the cash flow and the receivable is going to come from individuals over there who are the borrowers. In trade finance, the cash flow and the receivable is being paid out by AAA or AA rated companies like Amazon, Tata Motors, and so on and so forth. And you have also a diversified exposure there. So you're effectively taking risk on cash flow coming from these very large corporates vis-a-vis in, when you do PTC of other underlying, other NBFCs and then underlying book, those are typically cash flows coming from, let's say, individual investors. So that is a big difference in risk. Other than, I would say some of the point that he already mentioned on, why inherently, there is a banking system, can actually really collapse for, both the buyers and the suppliers, when they, I would say, not make such payments, right? So beyond the inherent things, I think this fundamental difference is good to note. Asking Arvind sir a few more questions. What is the role of, and so we understand buyer and sellers and a factor. What is the role of a originator and a servicer in, a securitization transaction? And if you can add on to that, what is also, because in this chart we see two new things, which is an SPV, which is like what is a special purpose vehicle or a SPV doing in a securitization transaction, and then and also what is the role of a originator and servicer?
Okay. Thanks, Saurav. Useful point. So
Hmm.
when we do the receivable financing, we own the receivables. We own these invoices. Now, if we enter directly into a contract with the retail investors, then they are always reliant on us for, first of all, disbursing the loan, checking the loan, and collecting the loan and paying them. So there is a risk that if something goes wrong in my organization or if there is a fraud, then the investor has to come and talk to me. The SPV is a trust. When you sell the asset, when the person who has done the business, Earth Padat Factors has the receivables, we sell the receivables into a trust. Why a trust? A trust is bankruptcy remote. It's a special purpose vehicle. It is not doing any other business. Its only job is to hold these receivables, collect the payment, and repay the investors. So nothing else can happen. Tomorrow, there cannot be a new loan that the company took, which can suddenly cause a default. In a trust, such things don't happen. It is only set up for one purpose. It's held by a trustee. The trustee will check the assets. Are these accepted? Do you have the relevant proof to show that the invoices were reported on the GST system? So all of those checks they do before disbursement. So there is a third party element to having an SPV, which is a SEBI registered trustee. Only the people who are debenture trustees registered with SEBI can act as a trustee of these special purpose vehicles. So that is what an SPV is. The originator is the person who sells the assets because he originated it. He made it happen. He was the first person to part with the loan. He's selling it to the SPV, so he's called the originator. And then once you've sold it, he has the equation. He knows where to go, in which account the escrow is coming. Do we have to send reminders? So 5 days before due date, we send reminders to everybody. Not that it is really required because it's on the portal, but it's useful to send the reminders and keep everybody alert and say, okay, you have to follow up for payment. So the servicer is the person who will keep following up, checking that, okay, these invoices got paid, which of those was securitized, give all that information. That again is the role that the originator does. The trustee will vet what the originator or the servicer does, but the trustee is more of a checking person. The originator does all the work. Hopefully that answers. Was there anything else?
No, I think that is very, very useful. So going on to, I would say the next section, which is, in like just covering some of the key, points that people should be aware of, when at AP Factors is actually doing a securitization. What are the things that, checks and balances in place, that are already there, before we actually, get into this securitization transaction, before we get individual investors to actually participate. So what are those checks and balances in place, which is the added, I would say that all the thing that we have spoken about in theory, how are we actually ensuring that, those robust practices are implemented and we have a good quality pool at the end of the day? If you can talk on some of these.
Sure. Thanks, Saurabh. So when we do the receivable finance, when we set up a limit, the first thing we do is we tally the GST ledger with the actual ledger. That is, we go to the GST network of the government of India and we say that, okay, if my client says he has sold 100 rupees to Amazon, has he actually done that? Has he paid the GST on that? So we know he has paid the tax. It's unlikely that he would pay tax on a imaginary transaction. So the transaction is genuine. We also check his past track record to see, okay, if he supplies goods, does he always get paid? If he has a good track record is when we start the process. Once we start the process, we buy the receivable from him. We buy it only after we check on the portal or we have an email from the buyer saying this is the amount, it is due. We accept that we are obliged to pay. So the first thing is not only is the invoice genuine, the amount is frozen, the buyer is acknowledged. When we do the transaction, we serve a notice of assignment on the buyer. So the buyer knows we are involved. We tell him, as part of the notice, you have to pay into an escrow account. You cannot pay the seller directly anymore. You have to pay it into the escrow account. So that is the step 3. The payment comes to the escrow. We do not have to follow up with the seller saying, hey, this payment was supposed to come at the end of 30 days. Has it come? No, it's come into the escrow. We can see it first. He cannot touch it without the consent. In our case, he cannot touch it without the consent of access trustee. Then the other thing that we are required to do as a factor is register the charge on this receivable in KERSAI. This is a government portal where all charges, if you do a mortgage, you're supposed to register a charge. It gets registered in KERSAI. So in KERSAI, we will go and we will say the registrar of charges, ROC, is the person who runs the KERSAI. He will say, okay, the receivables due to Ceres Foods from Amazon are pledged to AP Factors. So that is a regulatory requirement. What it does is if tomorrow some bank comes and tells us, hey, you know what, I gave you a working capital loan. This receivable has come, it should be mine. You can say, no, 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 no. This receivable was sold. We tell the banks upfront that this receivable was sold and look, here's the title. I own the receivable and in turn I have sold it to the trustee. So the government itself has a record recording that we are the owners of this receivable. So that is the KERSAI registration. Now, what we also do is in small and medium enterprises, lots of things are taken for granted that they will do the necessary actions, that they will not do anything stupid. To ensure that there is skin in the game for these guys, that they behave properly and so on and so forth, we take a UDC, a undated check, a post-dated check, etc. And we take a personal guarantee to say that, okay, they will ensure that there is smooth process. So let's say there is a delay. I want the seller to talk to the buyer and say, hey, explain the delay. Normally, there are delays of 1 or 2 days. So recently, we had a situation where Flipkart had a transition and they paid 1 day late. And it is so rare that we actually asked, hey, you want to tell us what happened? And he put us on a call with Flipkart. Flipkart said, look, it's 1 day late. It's an operational error. And it came the next day. So that is the other thing. But then what prompts the seller to listen to us? He's on the hook. He's not gone away. Just because we are relying on the buyer doesn't mean the seller is not going to cooperate. He has an equation with the buyer. He will help us. We have recourse to both the seller and the buyer. We can go back to the seller and say, hey, look what they have deducted 50 paisa for this. Can you please make it good? Now, traditionally, we only fund 75% of an invoice. So in this PTC, which we are doing, although the total financing, 75% is the senior tranche, that is 7.5 crores. But the pool itself is 13.3 crores because we have funded only 75%. So they have a cover which is very, very significant. It's not just 25%, it's a lot more than that, because we do not fund 100% of the invoice. And the way we do it is that is the skin in the game for the seller. We have recourse on both the seller and the buyer. We look for a satisfactory payment track record even before we set up the limit. So we look at the ledger for the last 2 years. We see that the collections are very good, that there is a good explanation where there is a delay and so on and so forth. Very rarely do we touch anything where the shortfall is more than 5%. Almost everybody has a good collection track record. Only then they become a client. The units which PTCs are done in, these are demat units. So you can identify them easily. They can be sold and bought in lots of 1 lakh effectively. So the demat process helps ensure that there is no dispute on ownership. The trustee is responsible for repayment of interest and of principal. And that is again a very useful feature of the RBI and SEBI guidelines. Plus, of course, security cover, we have said it's a 15% first loss guarantee. But let me reiterate that on this pool of 7.5 crores, the effective total pool of invoices is 13.3 crores. So you have actually a lot more collateral as well.
So one question over here for you is how do you track that a payment on a particular invoice is, for example, delayed? So because there are so many invoices in a pool across so many anchors, so how you actually able to track invoice per invoice collections, or whether it's getting paid on time, due date, when did the money come in? This money has come against this particular invoice. So how are you actually able to track this?
Yeah, thanks, Saurav. That's, I think, one of the small words which we put out when we said we are a factoring company is we are a fintech factoring company. So the whole thing is a fairly well-developed automated system. It'll tell me that, so if we say that, okay, typically Amazon payments are supposed to be coming in 30 days, at the 25th day, it will automatically send out reminders. On the 30th day, the system will pop out and say, hey, these are the due invoices of today, and what is the status. So immediately we go and check the escrow accounts. And the escrow accounts, if the money has come, that's great. Usually we receive monies 1 or 2 days before the due date because clients don't necessarily wait till the end. The payment cycle happens 27th of the month, 28th of the month, they will pay. And that's part of the process. So the system is what the computerized system, which is a fully automated, digitized process. That is what helps us track it.
So I'll just again, to summarize 2 or 3 key important points over here. First and foremost is that all of this securitization is done post a satisfactory track record, right? So there is a cycle of, I would say, history and cycle of payments and collection between the anchor and the supplier or the MSME SMEs. And post that satisfactory history is when this is being done. The second is typically we hear in invoices that invoices can get questioned whether the service or good was delivered or not. That is not a risk over here because this is done after the invoice has been accepted on a vendor management portal that, for example, Artfine checks. So there is no question that the invoice is disputed because the securitization is only of accepted invoices. The third general risk is dispute of who owns those receivables under an invoice, because a typical company might have multiple lenders and financiers, and that is where Karsai comes in. So once you have created a charge on Karsai, as Arvind sir was mentioning, there is no dispute on who owns this receivable. This is filed on a portal with RBI. So that also dispute of ownership of the receivables is taken care of. Fourth is obviously the entire concept of, I would say, first loss and the security cover. So in our current example, if the whole pool is of 130 rupees, the entire PTC tranche or debt is given is of 100 rupees. So even the equity tranche holders are sitting on some cover because only we have not funded 100% of the invoice. So from 130 rupees, only 100 rupees is the financing amount. Out of that 100 rupees, about 15 rupees is the equity tranche. So the senior and junior tranche combined is basically sitting on a cover of 85 rupees versus 130 rupees of cash flows. So 130 divided by 85, that is the kind of cover that people are sitting on. So, and all of these receivables are from grade A companies, AAA, AA rated companies. So you have to see quite a few of them actually have to default, for anyone to lose any principal or interest over here. So that's just, re-summarizing everything. Now, the next question I answer for you is, why should individual investors actually participate in PTCs? I think the second part, how is it important for borrower and clients? Obviously they are getting access to liquidity, so that we have spoken. But coming to the first point is, as individual investors, why should we consider PTCs? I think you touched upon it briefly, how a PTC is different from bonds, because I could also invest in, let's say, similar priced bond for a 14-month tenor. So how should I think about investing in a bond versus a PTC? And why do you think that PTC is such, let's say, a good, allocation in my portfolio?
Sure. I think the portfolio allocation is a good way to approach it.
Hmm.
When you're doing a bond, no doubt you should do bonds at some part of your those thing. You can do fixed deposits as well. They represent dues from a single company, and there is a certain expectation that this is a top company, nothing will happen. That explanation is multiplied in the case of a PTC. That is, instead of being exposed to one entity, you're exposed to a pool of entities. So the probability that any of them will go wrong is vastly lower. Plus, of course, you have the cover of the first loss. In a bond, you have asset cover. That is not the same thing at all, because in order to realize asset cover, you have to sell the asset. There is a repossession risk and all of that. In a PTC, none of that matters. It is the cash flows come regularly, and out of the available cash flows, you get paid first. So it's a position of priority and seniority in comparison to a bond. The bond is usually pari passu with banks. In a PTC, you own the receivable because your ownership is in Kersai. The guy has to pay you. The banks cannot come and touch that. Whereas if you are in a bond, you will be on par with the banks. Now, if you're investing in a good bond, these risks may appear small. But as a principle of diversification, if you want to take certain amount of exposure on one given name, regardless of how good it is, you should cap it and you should say, okay, maybe 5% of my business goes to this, of my investments go into this particular asset. But beyond that, let me diversify a little. So that is the principle for why a PTC makes a lot of sense, because you are exposed to a variety of borrowers. Most, even if some of them fail, you will get paid in full. So that is one big difference in approach. Why should you think of a PTC as opposed to, let's say, the stock market? That's a simpler one. The market is volatile. In the last 3 months, we've seen how volatile it is. The 10-year returns in the stock market are in the region of 12 to 13% before you pay your mutual funds or before you pay your PMS guys or your brokerage. Here, you're getting a return which is comparable for a much shorter tenor, and it's an assured return, and you're not exposed to daily heartaches. So that's briefly my pitch on why I would say you should think of having a PTC.
So I think, just to summarize, this is coming from the principle of diversification, as Arvind sir mentioned. So, if you want to invest in a bond and diversify your risk, because in one bond you're taking single counterparty exposure, to diversify, you have to invest in 10 bonds. You actually have diversified, I would say, exposure when you invest in a single PTC. So I think so one PTC is as good as, like, let's say, investing in multiple bonds. So you're consistently ensuring that you are diversified. Even, let's say, a AAA rated company, let's say, gets and can default, right? We have heard of, let's say, a DHFL, or some of those cases, you are likely to lose a significant portion of your principal, let's say, in a bonds case. But in case of a PTC and securitization, once AAA counterparty also defaults, but given that there is a first loss cover and additional covers, very likely you will lose your principal or interest, and if at all, it will be should be a much more, I would say, lesser significant amount. Right? I think that's the way to think about it. And I think all the benefits of bond, from it being fixed income, from it being tradable, all of those are also carried on to a PTC and securitized instrument. So the good things also carry. So again, back to Arvind sir. Right now, we have two opportunities, that both of us have done. It's live on Giraffe. So there is a senior tranche and a subordinate tranche. If you can just explain quickly again, how should we think about risk between the two tranches? And if there's any other nuance that you would want to highlight.
I think, see, the pool itself is very safe. We have had in the last 3 years no NPAs, and that is without tranching. In fact, days past due is rarely gone past 5 days. So that's where the pool itself is. The senior tranche represents a level of safety where even though we are a very small company, the pool itself is due from AA and AAA rated guys, a small portion from A rated guys. So the top 75% is rated A minus. It is an excellent instrument. The subordinate instrument is one level lower on the scale, and that's why it has a lower rating. So it can only get paid at the end of the tenor. The senior instrument can is eligible for getting its interest and principal paid first, and only then the subordinate, and lastly the equity tranche will get paid. So both the instruments, I would say, are safe. They are good investments. They represent slightly different risks. And it is up to the comfort of the individual investor to say, okay, look, I think it'll all perform. I'll take the subordinate tranche. I think I want the safest. Then you go for the senior tranche. The way I see it is senior tranche should ideally be compared to a bank FD or to a AAA rated instrument because effectively that's the quality of the pool. And I don't say that merely as the founder. I also advise World Bank right now, and that's pretty much the same advice we've been giving them. And that's how many of the top institutions, financial institutions in India look at it. So that's briefly a professional view.
I think one thing I want to highlight when we look at other bonds also on our platform and otherwise, one risk that we keep talking about, for example, is also reinvestment risk, right? Like, so while these are some of the key risks, that we understand, and I think we have spoken about a lot of these, one key risk has always been reinvestment risk. Now in PTC versus a bond, the reinvestment risk is also inherently solved with, so because as we are mentioning in bonds, what happens is that you will typically have a monthly or a quarterly payout of interest and or principal. So when there's a payout of principal, then you need to actually think about how will you reinvest that capital to earn the same kind of return. In a PTC, because there is a inherent replenishing structure, the money that comes from the receivables actually gets redeployed in the same pool, earning the same return. So your reinvestment risk is kind of solved for, and the money that you get is actually compounded after, I would say, these reinvestments at the end, let's say, of a 14-month, right? So that is an additional advantage, I would say, of investing in a PTC vis-a-vis investing in a bond. I think one of the key, the risk I wanted to just talk about, that I think the rest of the ones are quite self-explanatory and we have spoken about it. But what about commingling risk? If you can talk about, what we think of as commingling risk, is it there in our current PTC that we have launched, and how, how should we think about this? Yeah.
Yeah, excellent point again.
Hmm.
So commingling is when the buyer pays. If it comes into my general cash flows, then it is up to me to segregate it. I have the risk that, look, I should have actually, so there was a clerical mistake. Let us say I used the money to pay the wrong invoice, or I used the money because I had an urgent bill payment. That kind of thing is the commingling risk. In our case, we have first of all an escrow. So there were two levels of commingling risk. If the buyer pays the seller directly, then I have to chase the seller to get the payment. It's commingled with his other cash flows, with his other obligations. Here, because we have an escrow, that doesn't arise. The buyer pays into an escrow, the seller has no access to those funds. The second step in our PTC is access controls this escrow. Even I can't touch the money. So the moment the money comes in, I have to send a report to Access saying, hey, this is the funds which have come in. This is the narration. So much of the money has go to you for the trustees to repay the existing invoices you have. Here is the proof. This is the payment advice that the buyer has sent, saying this relates to invoice numbers, so and so and so. And then the trustee takes the decision to release the cash flows from the escrow. That's part of the structure which ICRA has approved. And this is confirmed by a chartered accountant. For every month, we have to submit a certificate, but he is certifying it on a daily basis. So actually, every day the trustee will say, okay, have they done the allocation correctly? Have all the payment advices been done? The CA vets it. And of course, the trustee itself has the right to see all the payment advisors and check it itself. So that is how we address the commingling risk. Here it is very low.
Sorry. Yeah. So I was saying
Yeah.
thank you, Arvind sir, for that. Very helpful. We have about 5 to 10 minutes. We might extend. We'll overshoot on time. But we'll take some questions. So there's some questions in the chat which I will start taking. The first question is, how do you get access to the site of the buyer to check whether the invoice is accepted or not? So we mentioned there is, a vendor management portal that we typically check. So the question is, how do you get access to that portal? Is there some arrangement with the buyer that we have?
See, in some cases, we have arrangements with the buyer. In
Hmm.
most cases, in all cases, the vendor, the seller, has given us the permission. He has given us the login ID and the password, and we put in the bot so that he can help us get that data. So we know that that cannot be tampered with, and that data comes to us directly from the portal. But it is the seller because he's our client. He's the guy who's getting the money. He's cooperating to make that happen.
The second question is, what is the difference between SEBI and RBI regulated, and whose regulators have stringent norm towards being investor friendly? I can take that question, Arvind sir. So the first is, it becomes RBI regulated when there is a originator in between that is RBI regulated. So if the originator of the PTC is a NBFC like AP Factors, or let's say it is a bank or any other NBFC, then a PTC with a RBI regulated originator will overall this transaction will also fall under RBI securitization guidelines. Now, SEBI steps in when at the time of listing any PTC. So if you list a RBI originated PTC, it also becomes SEBI regulated. Now, there is another way where if the originator is not a RBI regulated originator, then you can only do it through a listing mechanism, which will then make the overall transaction only SEBI regulated. Now, in case both, I would say SEBI and RBI have more, stringent norms. But RBI, because it looks it as this as a financing transaction, there is a lot of emphasis on, MHP, MRR, which is a minimum holding period, before you can actually do securitization. How much retention should the originator have? A lot of these are actually more stringent on the RBI side than it is on the, SEBI norms. SEBI has updated some of these norms which are not yet notified. But as the law stands today, the RBI ones are actually more stricter than what SEBI is. So SEBI is mostly governing the listing process. RBI looks as more of the factors on the credit aspect of it as well. The next question is, uh, what is typically an ROI on such investments, and what is a minimum ticket size? Again, I'll quickly take this, Arvind sir. So the minimum ticket size right now on our platform is 1 lakh rupees, and those are for the RBI originated ones. ROI typically, as Arvind sir earlier mentioned, if you do the same transaction on trades, this is at 7-8%. But we are able to do it, I would say, at about, at the rates that you see between 11 to 13, or, 12 and a half. Right now, I would say that is basis on the current underlying pool. Depending on pool to pool and, what kind of rating and security structure is there, the ROI may be different, right? So I think you should look at it, the ROI at least should be looked at it at a transaction basis, and what kind of security, what kind of pool, and what kind of asset is being securitized. So that's the way to think about it. Arvind sir, the next question probably you can take. The question is, if there is a safety of 130 rupees versus 100 rupees, which we said that we don't finance the entire invoice. Let's say the pool is 130 rupees and we have only financed 100 rupees. Then why is the subordinate tranche rated triple B minus? So when there is a cover of 30 rupees, why is still the rating triple B minus? Yeah.
Yeah, good question. See, I think the Indian rating system and the financial system likes bankruptcy remote, but it still believes that the originator rating has something to do with the overall pool rating. So these are conventions. The convention is that the maximum rating benefit you will get is 4 notches above the base rating of the originator. So that is the senior tranche. So if the base rating of the originator, because we are a small firm, we are 3 years old, we have a equity of 15 crores. We ourselves are unrated. Because we are unrated, the subordinate tranche is triple B minus. The same pool, when we did it for Centrum Finance, 3 years ago, we had a pool of L&T receivables. Those were rated A1 plus, that is triple A. Why? Because the net worth was over 100 crores. So a lot of the uh, securitization pools that you see, you might see personal loans where the traditional historical loss rate, or microfinance loan pools where the historical loss rate is as high as 10%, but it will still be rated AA or AAA because it's from a strong originator. So that is a bias which the Indian rating system has. They don't really truly see this uh, as a as something which is bankruptcy remote. In our case, it really is bankruptcy remote, because if tomorrow everything fails, the escrow is controlled by the trustee. They own the receivables. They can use the cash flows. They have enough to pay the interest and the principal of the senior and the subordinate guys. They don't need us. But that's not necessarily something which has been proven. It's a new asset class. It'll take time for people to appreciate these nuances. So, to give you a perspective, the triple B minus is the minimum rating we needed for it to be listed and to be able to be subscribed by PMS companies and so on and so forth. So we said, okay, you help with that. Uh, Eventually, we expect that these numbers will correct. To give you a perspective, 25 years ago, when securitizations were starting in India, Shriram used to be a very pioneer in that. And in the early deals, they would give securitization collateral of up to 50%. 50%. Today, they do collateral of 5% across the whole pool. They would do only 5%. But in those days, it was 50% because it was starting. The industry, the asset class was starting. So as the asset class matures, you can expect the ratings to change and reflect the true risk.
Thank you so much. So the next question is, are there any deductions like TDS applicable on the returns, and is there any option of exit, midway for an investor?
Saurav, you want to take that? Or
Yeah, so see, in case of option, again, it depends on of exit. It depends how it is structured. There have been instances where there has been an option is provided in case you want to exit at the end of 6 months, 9 months, and so on and so forth. So again, you need to look at it, customize basis the instrument whether that such an option exists or not. The second is in PTCs. The TDS applicable earlier was 25%. There is again for individual investors in the recent budget, that provision is scheduled to be revised. But the TDS that is deducted on PTC return on the interest itself is 25%, which you can claim at the time of your filing.
so, sort of that
Mm.
the opinion has come from KPMG. In the
Okay.
new budget, it is 10% from April.
Okay. So
So I
from
think
1st April, yeah.
yeah, 1st April onwards, it will be
Hmm.
10%. So for this
Okay.
particular PTC, it would be 10%.
Hmm.
The
Sure.
other
Okay.
choice is that
Hmm.
it's a listed PTC. So if you can
Hmm.
find a buyer, you can exit. And if you've held it for 12 months, you can probably claim capital gains. We've checked
Mhm.
that with our tax advisors as well. And they say, look, if you sell it after 12 months, then definitely you can claim capital gains. Can you find a buyer? That's something which I think we are not allowed to make any promises. That's
Yeah.
part of the RBI regulation that I can't give a put and call option. Uh, if somebody has a liquidity issue, we are certainly happy to talk.
So, just to reiterate, because this is a listed instrument, if you sell the PTC after 12 months of holding it, but before the maturity, then the entire gains that you will make, will be treated as capital gains. And on listed securities, the capital gain is 12.5%. So, on a long-term basis, right? So, if you are able to sell this instrument, let's say after holding 12 months or before and before maturity, the taxation is 12.5% on your gains. Liquidity and buyer, those are obviously things that are not guaranteed. but you can look it at up for yourself. As Giraffe, we can help you find one on a best effort basis. But obviously there are no guarantees on finding liquidity, right? The next question is it correct to say that PTC offered on Giraffe is both regulated by RBI and SEBI in comparison with other SDIs which are just regulated by SEBI? I think the answer is yes. So the PTC offered on Giraffe, as we said, because it is originated by a NBFC, that factors, it is RBI regulated, and the fact that it is listed, it means it is also SEBI regulated. Where you see some SDIs which are not, I would say, originated by a NBFC or a bank, those are just SEBI regulated. So the RBI regulated one, as I said, ensures a bit more protection because the norms are, stricter on the kind of credit that you can do. So there's a question: in your professional opinion, Arvind sir, would you recommend this product to your friends and families?
In fact, I have, and many of them have invested as well, and they have invested through Giraffe. So quite a few have invested. My classmates, my family as well, and so it is a good product, and definitely I have no hesitation in recommending that.
The last question is, what is the frequency of interest payment, and is the principal paid on maturity? Uh, there was another question, which is similar on these lines, that in a bond you get fixed yield and in a PTC the expected cash flow is different then from the actual cash flow, and why is that, and how is this difference being paid to investors? So I think people feel that in PTCs the proposed repayment schedule or the repayment schedule at the time of doing the issuance sometimes is not followed, and there are actually early prepayments, and we have seen in some other PTC. So I think two questions. So in this particular one, what is the interest and the principal being structured? And second is, how should we think about, cash flows coming in early, which is different from the actual repayment schedule?
I think the second one first. In this case, we have a replenishment structure. So, regardless of whether there's a prepayment or not, even if the program terminates for various reasons, and there are early trigger. So, for example, if 25% of the pool does not perform properly, or if we are not able to find new assets, the portfolio itself, the pool itself terminates and the program stops. But even in those conditions, the interest promised for the full tenor is to be paid, and it will be paid. Artfine has done 5 previous issuances of PTC. They have all been retired uh, without any loss of interest, and they have been retired on due date. Uh, so definitely, this is a fixed income product where your return is not going to be affected by prepayments. The traditional way to handle prepayments is to pass it back because those are static pools. There's no replenishment there. Here we are able to reuse the cash flows to buy new invoices, so the risk of prepayment is nil. The first question around, can you just repeat the first point, please?
So what is the schedule for this current
For
issue?
this one, it is 14 months. So we have said it will be paid at the end. This is basically for some people who feel they can sell it after 12 months, then that advantage remains with them. So the interest is paid along with the principal at the end of 14 months.
So both interest and principal will be paid on maturity at the end of 14 months. The last question is, what is if there is a TDS, as we mentioned, which is now 10% on this particular issue, if someone is not eligible for, let's say, tax because of their income, how do you save on the TDS that is deducted? Do you get a Form 15, etc.? So to answer that question, because TDS will get deducted, it will reflect in your 26 AS that the TDS was deducted. And at the time of filing, if you have lesser income than the threshold, you will say that the tax is already paid because this TDS was deducted, and automatically you'll save on the TDS deduction. So, there is no requirement of a Form 15 to save this TDS deduction. Your CA or whoever you file your tax with, at the time of filing, this will take care of itself. So because the TDS will reflect in your 26 AS, so the tax is already paid on your behalf. So if you are not eligible to pay any tax, you can actually claim this as a refund as well. So that's on the TDS part. I think the last question is, what if there's a cash flow delay and and if the cash flow is delayed from the repayment schedule? So, so how do we think of tackling? I think the question is, if there's a underlying repayment that is due, but let's say the cash flow from the receivable is not coming in, how should we think of that risk?
I think a lot of that is addressed in the diversification. So for this particular pool, I think on their first day, there were over 900 invoices and 25 buyers. So for any senior or subordinate investor to see a delay, clearly about 200 invoices have to get delayed. That's a lot less likely. It's a very unlikely event because on 100% of our book, we have delays of less than 5 days. So typically, that's how it is. Plus, the rating agency has put a condition that 15 days before the maturity date, we start accumulating cash flows and keep them in AAA instruments. So what happens 15 days before is we have the replenishment stops. We do not buy new invoices. We only accumulate all the payments. So we have 15 days to collect everything and keep it ready for payment on due date. And during that 15 days, it's either sitting as an FD or it's sitting in a GSEC or it's sitting in a AAA rated trades asset, which comes always on due date. So that's how we manage this. So we are not waiting saying, okay, it's delayed by 2 days, so I'm short. That doesn't happen. So well before the maturity date, the payment process starts.
So thank you so much. We have already shot, I would say, 12 minutes, beyond schedule. So, thank you for all the interest. Thank you for, participating in this webinar. We hope to have I would say, many such webinars in the future. And thank you, Arvind sir. This was very enlightening, and hope to have you, on a webinar with us again. So thank you so much.
Thanks, Saurav, and thanks, guys. It was great having me on this. Thanks.